we usually find it really difficult and confusing to identify trend reversals. To determine the reversal trends, we have to wait for a breakout, which means the price break through the bottom making the higher high or break through the top making the lower low. However, from the way we trade in this video, you can identify an entry point for reversal that could determine the upcoming trend, bring a lot of profits. Of course, with the explanation of the bull-bear law, you can understand the price action in the meantime. And you can also see that even if it's a reverse entry point, it's still a safe one. Another thing I would like to mention is that everything I share with you is based on the market fundamentals. Therefore, it can be applied for every market, including forex, stocks, and crypto. As long as it has charts, you guys can use this method. To be frank, I don't read a lot of books. This method is based on my trading experience and how I observe the price move. After that, I summarize it to make my own effective strategy. Firstly, we need to know about the term called the leading wave. It's usually a steep wave where the candlesticks had a little wicks, and there is a color repetition. For example, here we have a downward leading wave, and here is an upward one. These waves are not considered as leading waves because they have many wicks and their amplitude is small and low, and the colors are alternating. So what's the trading psychology within these waves? Look at the price move of leading wave. We can conclude that there is a completely overpower of the bull or the bear. In this wave, the velocity of the price is very fast and strong, which means it can move a long distance in a short period of time, and it's different from other waves because it's made of small and short waves. It has many up and down wicks, and these stages don't show a clear overpower of a side. At this point, the bulls and the bear are like two buffaloes fighting each other. You can imagine that these two sides are having a tough war, but neither of them dominate the other. So we can understand the characteristics as well as the price action of the leading wave. So how can we apply it in trading? First, we need to review its characteristics. For example, we have a leading wave here. At this point, the bear are completely dominant, and because of that, the bull is very weak and the pullback of the bull are not going up strongly. Another thing that you guys should notice is that when a leading wave appears, usually create a second wave with the same direction. Because when the bear is strong and dominant, the bear are really aggressive. And when the price hits a level, usually it's an old bottom zone that the price has broken through, or the zones that is a price conflict in these leading waves, because at these zones, the bear need a strong force to move the price down. So when the price reaches this zone, the bear will rush in and force the price down. After the price has gone down, there are two outcomes. Because before that, at this point, the bull has pushed up. This is the bullish zone. So the first scenario is that when the price hits this zone, the bull continues to participate in the market and push the price up again. The second scenario is that the bull cannot continue and the price continues to break the bottom and go down. And during the trading process, if you observe closely, you can see that it's frequent to encounter these outcomes. For example, here we have a downtrend leading wave. And when the price reaches the bearish zone, it continues to be pushed down. However, before that, we can see here is the bullish zone. The bull continues to rush in and it has kept this error. So it belongs to the first outcome. And here's an example of the common trading structure when a leading wave goes down and then there's a decline breaking the bottom. So it's a case of the decline structure that we usually encounter. So how can we apply the leading wave in a reversal pattern? Now we have an uptrend, and then a strong downward leading wave, so that we have a bull power of the main trend, and a strong decline force of the leading wave. This fork could be a level with a larger time frame. So when these two sides conflict each other, it will have a price conflict scenario, which means the sideways. Although the price had not broken through this area, the struggle is still increasing. So when we encounter this case, we will wait for a breakout in this horizontal zone. Or we can wait for a pullback and look for a signal to trade. Since these leading waves frequently show the ending of the trend, it's a signal that the bear is rushing in quickly if it stays at a strong level of higher time frame. So this is where the bear rushes in dramatically, and this zone is the conflict between the bull and the bear, which means the last effort of the bull pushing up, and it officially ends when the bear breaks over this area. So the last condition is that we have to wait for it to break through this area, because in many other cases it still have a decline leading wave and it experiences a sideways stage like this. However, the price does not break through afterwards. Instead, it makes higher high and higher low. So at this point, it proved that the bull can protect this area, and it continued to push up to make a higher low. In terms of the bear, it tried to rush in, but this higher low made the bear exhausted, so the price continued to rise afterwards. Therefore, in this situation, we don't have an ideal entry point to sell order. We can look for the signal to buy, or we can stand outside the market if we feel that it's not safe enough. Now we will have a practical example here. Here we have this gold pair in 4-hour time frame, and before that there was an uptrend structure like this. However, at this point we can see there was a previous strong decline force and massive momentum, and the candlestick could also be a wave. So now when the price reaches this area, which is a potential zone to sell, now we will focus on the one time frame to observe the price progression. At this point, it's really risky to sell, so we will continue to look at the price move. Here we have a strong downward leading wave. We can see clearly that this red candlestick declined dramatically like this. So here is our scenario. Because there was an uptrend before and there was a downtrend wave, we're going to wait for a consolidation at this zone, then break downwards. Then we will wait for a signal to sell, and of course, if it does not go that way, it may have a sideways here, but this area is like an irregular sideways. It looks like a megaphone, so we don't have to trade if we don't feel it's safe enough. However, if the price moves just like our previous thought, we will wait to sell. At this point, we can see that when the price reaches this conflict area, the momentum declines significantly. So after that, the price has been forced down. It breaks through the bottom of the bull and creates a sideways like this. Then there is a bearish momentum. Another thing we should notice is that in this area, the amplitude is gradually smaller. We can see that here the bottom is higher and the top is lower, and then the price breaks through down to this point. So here we can place a sell order. The sell order looks like this. The stop loss is in this area. The first thing we should notice before placing an order is that we must consider where should we place the stop loss order. After that, we could consider the take profit, and we must determine whether the risk-reward ratio is good or not. This take profit point must be potential ones, which means when the price hits a strong level, and if we feel that there could be a reversal, and when we place take profit order there, it could bring us a good RR ratio. Then we should wait for the signal to place orders. So now we have an entry point, stop loss point, and regarding our potential take profit point, it could be this area, or even further, because these areas are the origin of the previous wave where the bull has pushed up. So frequently, when the price hits these zones, the bull continues to rush in. Therefore, if the price moves similar to our strategy, which means it goes down, we should observe this level. If there are any green sticks appearing, it proves that the bull side has started rushing. However, if there's a red candlestick or a strong downward red wave that breaks through, we can play take profit in further position. Now let's continue to observe the price move. We can see there's a dramatic breakout in these areas. And in this case, I will also mention about how we can take profit. First, when we place take profit in these areas, and we feel that the RR ratio is good enough, and if the price hits take profit, the trade is now over. Even if it continues to move, we shouldn't regret it. In the second case, if we expect further, we wait for the bear make its own zone, which means when the bull pushes up, the bear makes the bearish zone and pushes the price down again. Then we will move stop loss to this area. Likewise, here we also move stop loss to these zones. Of course, there's no strategy that could be optimal in all cases. Regarding this method, it has cons, which is in case of the price making its own zone, then it raises up and hits stop loss, so we can only close take profit order here. However, in case we close orders based on the level or a fixed risk-reward ratio, we can catch opportunities in these areas, so that every strategy has both pros and cons, and you can choose whatever you want, as long as you accept it and still win in the long run. Of course, we won't encounter these ideal cases every time. You may wonder why I place orders so easily in my video, but when you apply these methods in the real market, it seems so difficult. For example, in this case, we also have an uptrend, a leading wave, and a sideways. But we don't have the price breaking through this zone, which is also an important condition. The price then go up, and at that time, this is the second scenario that we discussed, which means you can stop trading because it does not satisfy the last condition, which is the breakout. Or you can wait for the buying signal in this case. This case is the same. Let's look at this area. We draw here and then choose the lower time frame. This wave could also consider as a leading wave, but its signal is not clear. However, in these zones, if this arrow combines with this previous level, there was a strong collapse before, and this time we can look for a scenario that the price breakdown in place take profit in the conflict areas, or where there is a strong momentum. This order is also a practical one like that. One thing I would like to mention again is we cannot always win 100% with that scenario. What we need is not always win. We should only expect that we can raise the win rate. The winning probability will depend on, for example, in this area, we have to find out whether it had a strong level before. If the answer is no, it's obvious that there is no clear proof that the bear will try to enter the market, so the win rate will decline. And regarding this nearest level, the price can go down there and then rise back up, so we shouldn't expect that we will win 100%. Just expect that the times we win will outnumber the times we lose, and it is fine even if the number of our wins is equal to the times we lose, with the risk-reward ratio greater than 1. For example, 1, 2 or 1, 3. When we sum up, we still have a positive value. Now let's take an example in a different market, let's say crypto. Here we can see the Ethereum in the 4-hour time frame. We can encounter a lot of similar cases like that. The case that related to the leading wave, that is usually an ending signal of a strong uptrend or downtrend. For example, here we have a downward structure and then there are some leading waves. Although horizontal stage within this area is not ideal, we can keep trading based on the bull bear zones or demand supply zones. This area is also the same. There's a downward wave, it's just like a signal for an upcoming trend, so that we shouldn't trade so quickly. Instead, we will catch the opportunity to sell in the area where there are good signals. For example, the price breakthrough in this area or at this point, it has an uptrend wave, and then the price moves horizontally and break through. So based on the basic rules, you can trade in every market. Another thing that may disappoint you is that you may understand these cases, but you still cannot apply it in trading. It needs a lot of practice. A lot of you don't have a clear strategy when trading, but still cannot quit it because you are addicted to trading. Many of you place orders aggressive and hope that one day you can achieve success. That would be the scariest thing that may happen to you, because that day won't come if you don't change yourself. I don't say bad things or good things about the market. I only say the truth of the market. So this is the end of my video. Goodbye and hope to see you in the next video.